So you are thinking of resigning from the GEPF and you are not yet at age 55. Now, this could be for various reasons. Maybe you're just frustrated and mentally you're not in a position to continue working. Or perhaps it just could be from a health perspective that your body is not able to allow you to keep going on. Now, whatever it is, whatever your reason for wanting to leave earlier, one of the things that perhaps you're concerned about is what happens to your capital. What are the options that takes place? Perhaps you're concerned what would happen from a tax perspective or investment, or maybe you're just not sure where to get started. Now, I'm Devanika, and I help GEPF members like yourself make one of the most important decisions, which is whether you should retire or resign from GEPF. And in this video, I'm going in depth into what would take place if you opt to retire or resign before age 55. And I want to share with you some very, very important secrets, things that most members don't get to know about. And this is the information that this video is all about. So let's get started straight away. First up, in terms of your GEPF statement, right? So I want you to analyze the statement very carefully. There's certain key information that I want you to pay attention to. Now, at the top of your statement, you'll notice a date here, estimate of benefits as at, in this case, 31 December 2018. Now, what you want to do as your first step is make sure that you are getting a GEPF statement, your statement, but request it as at the date or month that you are leaving. So, for example, if you're leaving in 6 months' time, you're going to request a statement as at that particular month, right, when you are leaving. Let's just assume that it is December of this year that you're watching the video. Then you want to make sure that you're getting a statement as at December this year. And the reason that you want to do that is that then allows you to get a more accurate resignation value. So let's take a closer look at the details, right? Now, naturally, this statement is blank because of the information is hidden, but your statement will have all your particular information. Now, a key aspect for you to note here is the resignation value that you see. So your resignation benefit. That would be accurate as at the date of calculation, right? Well, it says estimated, but it's a very close estimation, right? And this is important because you can only make an informed decision if you know the figures. The figures are relatively accurate. Meaning, if you have a GEPF statement now and it's showing your current value, but the statement date is as at today, and you are leaving in 6 months' time, in 6 months' time, your resignation value would be higher because you're still contributing and GEPF is still contributing. This is why I say your first step is getting a GEPF statement as at the date that you are actually leaving, because that gives you a more realistic value as to what the resignation benefit is actually going to be. Now, just a heads up, because I know you might be concerned, what if there's a penalty or some other consequence, right? Now, notice up here, in terms of retirement, where it's got normal retirement, you will see on your statement there's a number next to it, which is referring to some of the notes on the right-hand side, which we'll go through now. So where the penalty comes in, it's actually in terms of retirement, right? Not on the resignation side, on retirement side. So we look at the notes on the side, you'll see point number 9 here, and we're referring to point number 9 of the notes. Your notes will be similar, right? It might be a different number, but just look to the side where the number corresponds to read it. So what this note is saying is that normal retirement for GEPF is as at age 60, meaning that's the age that they are calculating it at. And these benefit calculations are estimated and assume you'll retire at 60, meaning when they determine this value, when they're determining the retirement value, it is calculated at age 60. So for example, if you are age 50 right now, your retirement value, the figures that you're seeing on your statement, it is calculated to age 60. Not the resignation value, the retirement value, right? Because resignation can happen at any stage. You can leave right now, and this is why that's accurate, generally accurate as at the date of the statement. Whereas retirement, GEPF is always forward calculating it, right? So if you're not yet at age 60, they forward calculate to age 60. If you're at age 60, they forward calculate to age 65. And notice the last part that they're saying, if you are leaving earlier, so before age 60 or before age 55, then the values will be calculated. But this again is on retirement. I have done a separate YouTube video on that, so make sure you check that out if you are wanting to consider retiring from GEPF, right? This video is all about resigning from GEPF. So on that note, let's take a look at the flow of your capital. What takes place at that point when you are actually moving money away from GEPF through to the insurance company? Well, actually, there's 2 options that you have available, right? So notice that your capital sits here. This is GEPF. That's where all of your funds are sitting. And one of the options that you have, right, is two options that are available. First option is you could take this benefit out in cash, and we'll walk through an example with that right now. If you are opting to take this out in cash, what you want to be extremely mindful of is what would take place from a tax perspective, right? The second option that's available, I'll explain the tax shortly. Second option that is available is you could say that you want to transfer through to an approved fund. Now, in terms of approved fund, maybe you've heard of a preservation fund. It is not your only option, right? So what you want to do is consider the options that are available. Make sure you're making the right choice in terms of the correct approved fund, because again, once you decide on that, you cannot change it. So you have two routes that you could take. One route is you could opt to have your entire capital paid out in cash. And the second route is you could opt for this to be moved to an approved fund. Quickly, from a tax perspective, if you are opting to take this in cash, whatever is getting paid to your bank account, that is going to be taxable, right? Whatever is getting moved to an insurance company is not taxable. So remember those. If you look at the amount of money that you are withdrawing here, cash, that's getting paid into your bank account, therefore it's going to be taxed. But money that's being moved from GEPF directly through to an approved fund, because it's not getting paid to your bank account, it's moving to the insurance company's bank account, it means there's no tax on this, right? Now, what would that work out to and how would the tax take place? Firstly, remember, we are now calculating tax as at age, well, before you have reached age 55. So I want to guide you on a tax guide. Whilst I'm getting the tax guide ready, I want to remind you that the tax guide is current as of the time that I'm shooting this video. When you are working with your taxes, please make sure that you're getting the latest tax guide so that you're able to follow, right? The information will be easy because I'll guide you along on the tax guide. So there are two tax tables that SARS considers when you are leaving or when it comes to retirement capital, right? The first is this table, which is a retirement fund lump sum withdrawal table. So you remember the word withdrawal. And the second is a retirement fund lump sum benefits or severance table. So just remember this one, retirement lump sum benefits. Now it's two different tables that we're working with, right? What's the difference between the two? For now, remember, you're just going to follow using the information that I'm sharing with you. You can always watch the video again and use your actual statement to do the calculations. So notice here, this second table has 500,000 that's tax-free, right? So you see from 1 Rand to 500,000, 0% of taxable income. You might have heard of this, the first 500,000 tax-free. That is only applicable, notice the fine print, on attaining the age of 55. See? Meaning if you get to age 55, you can make use of the table, or if you happen to be medically boarded, right? Notice they're saying incapacity if you're unable to continue working due to some health reasons, right? Now, so it's either at age 55 or if there's medical board. So one of those two options, right? Now, if you are not at 55, let's say you are at 50 and you're not disabled or you don't have, you're still able to continue working, but you just want to leave a bit earlier. In this case, SARS cannot use this table or they won't use the table, right? They would use this withdrawal table. And this is the table that we'll use for the calculation when we're doing it. Notice with this table, it says that the first 25,000 is now tax-free. So it's not like the other one where you had 500,000 tax-free. You now only will get 25,000 tax-free, which means very quickly you're going to move up the tax ladder here, right? Very quickly, this can start to become a major tax issue. This is why it's very risky if you are considering taking the money out in cash. So let's have a look again. Two options that we had discussed. One is you could have this amount paid out in cash, in which case you're going to be taxed. I'm going to do a tax calculation with you now. And the second is you could opt to take nothing in cash. And if you're taking nothing in cash and you're transferring to the approved fund, there's going to be no tax. Let's go see what takes place from a tax perspective. In my example, I'm just going to use a round figure just to make the math look a bit easy. And again, when you watch the video the second time around, you can press pause as you go along, use your figures, and then do the calculation, right? Now, I'm assuming that there is 2 million Rand that's sitting inside the resignation benefit, right? So now we're going to determine the tax. I'm going to guide you how to run the calculation. So heading back to the SARS tax table, remember we're using this table. And on the table, it says for the first, well, look at the amount of money that you have, right? In our example, we're using 2 million. You're going to follow along on yours hereafter. But the 2 million is more than 25,000. It's more than 660,000. It's more than 990,000, which means it's now going to be taxed at the highest scale, right? And what SARS is saying is it's 203,400 rands plus 36% of whatever is in excess of 990,000. Now I'm going to do the calculation for you, and again, you can do this on your own. So let's head over to a calculator. So what SARS is saying is the following. We have to first have your 2 million rand capital. I'm first calculating what is more than 990,000. So I'm minusing 990. So you have 1,010,000 more, right? This is what's more than 990. Now, this figure is going to be taxed at 36%, right? Which means your tax is 363,000. Now, hold on. That's not all the tax, right? Because if you go back to the tax table, what is SARS saying? They're saying whatever is more than 990,000, that will be taxed at 36%. But in addition to that, they want 203,000. And the reason for that is, how does it come about? 203,000 is made up by 18% of this figure, 660, as well as 27% on this difference, right? Which is another 330,000. That's how they come up with this 203,400. Remember, when you're doing this, you've got to make sure you're using the latest tax guide. So I'm adding in this case, 203,400, which means total tax now is 567,000. You can see it's a whopping amount to lose in tax, right? Now, be mindful as you watch the video, you haven't lost any taxes yet, right? The secret behind tax planning is you want to do that in advance, exactly what we're doing now. What you don't want to do is get to a point where you already have paid the tax, because then you can't recover it. So if you are opting to take this money out in cash, your tax that you're going to pay here is going to amount to 567,000, right? What does it mean? What would you be left with? So it's 2 million rand minus 567,000, which means your after-tax amount is now 1,433,000. Now you've got to ask yourself, is it worth paying that? This is a cash route. Let me take this out, because now what we're saying is this is the tax that you're going to pay. Now you want to ask yourself, is it worth paying that, right? Think about how long you've been working for government. Is it worth releasing or losing this amount of money to SARS? And what are your options? Well, in terms of the options, you could elect to have this transferred to an approved fund. If you are moving to an approved fund, remember there's no tax, right? If you are moving to an approved fund, you can then do a release from the approved fund, right? Now, in this case, you would be limited here to a 1/3 withdrawal. So 1/3 could be withdrawn here. But this time around, because it's a reduced amount, right? It's less than the full amount. It means the tax can be a bit lower. So this is another option that's available for you. The other alternative that you have is naturally to see if you can keep going to age 55, because that's when the 500,000 tax-free amount kicks in. Or alternatively, if you're moving to a new company, maybe in the private sector, you found a new position, or you're running your own business, and you don't need access to this, then you can just leave the money inside the approved fund until such time in the future that you actually require access to it. Right? Now, the next is in terms of income. Income options that are available within insurance companies usually start at age 55, which makes this process a bit tricky, right? Unless you cash out and take this money into some type of bank investment where you are able to get the income, or cash out and then move it to an insurance company, but by then you're losing a huge chunk in tax, right? So you want to analyze this information very carefully before you take the decision of actually leaving. Now, I hope the video has been extremely helpful for you. In fact, comment below to share with me what's been your key takeaways, right? If you were thinking of leaving, are you still in that frame of mind that you want to go? Is your mind changed now? Do you want to look at ways to save on tax? Do you want to try and see what you can do to get yourself close to 55? So comment below to share with me. If you have found the video helpful, give me a thumbs up sign. And remember, if you've not subscribed to the YouTube channel, I'm always providing information that allows you to make the most informed decisions with regards to your GEPF capital. So hit subscribe so that you're able to get access to these videos. Now, maybe this video is helpful for you, but I want you to start thinking about the next GEPF member. Perhaps there's someone else who's going through a similar situation that you are, wanting to leave before 55, then I encourage you to share the video with them so that they're able to make a more informed decision.